So I want to talk about what influences the property market. Now, here we use a 72-step process to identify a market. Okay, but they give you 72-step process. It's a long procedure. So I wanted to start this and give you as much value as possible, but give you from a bird's eye view when you're looking into a region and making sure this region is going to grow in value and going to give you the life and the choice that you deserve through property, because the property is going to grow up in value, grow in value, I should say. So there's 15 influences that we put into place so you can understand and make a decision that is not based, just on irrational, but it's rational. Okay, so here's 15 of the top influences that I've put together that we look at a particular market. So let's start off with infrastructure projects, something that's really important. And when governments are spending a lot of money on infrastructure projects, this is something to keep an eye out for. As you can see, every state and territory is getting billions of dollars getting spent. So when you start to see this, you got to make sure what is getting spent, because we want to make sure that these things are going to contribute to the economy and going to help and grow the value of the property. So for example, here we've got transport, we've got hospitality or hospitals, educational sectors, your schools and your universities, ports, airports, bridges, renewable energy farms, parks, etc. Now, these things can contribute, even new stadiums and stuff like that. And I'm talking from, a ground level, because these things will influence the market. When this is starting to happen in these markets, something's starting to change. Okay, so follow the infrastructure projects. Look at what's going on. Look at government policy, government plans. Look at the state. Look at federal, and even look at a council area plan. And this will tell you what's happening. So by doing this, this will create, a change of the demographic of people, and it will start to gentrify locations. If we look here, there's billions of dollars getting spent in the next, say, 5 years. So by making a decision, we start to say, okay, there's money getting spent in all these states and territories. Let's have a look even further and sift out on what's going on. Now, keep in mind, not every infrastructure project is treated equally, because people might think there's a new railway line going through a regional town or an outer fringe town, and that might have an effect on the market. It may, but this is something that you keep in mind. How many people are going to use that train line? And how many people have, if there is an existing, but they're doing a train upgrade line or an upgrade on the station, maybe something like that won't influence the market, but there is a change of, of what's going on. They're making it, maybe upgrading and making it a little bit more nice or user-friendly, but that might not have a massive influence on the market, but contributor of multiple things will have an influence. So if it's just a few things getting, incorporated into a suburb or a location, this is something to be wary of. You want to see a different things. If there's new hospitals, new schools, transport hubs getting built, maybe secondary airports or new upgrade of the port or new logistic companies coming in, tunnels and roads, etc. These things are something to keep an eye out for. You want a multiple of things getting implemented into a region. So as you can see, there's a lot of money getting spent, and this is a positive thing for the Australian economy, turns the economy around. Number 2 is economic drivers. Something I'll touch on that is super important. So we don't want to invest in a town where there is just a mining dominance and there's nothing else. For instance, Port Hedland, WA. This reliance on mining. If the mining sector drops, the property market drops. The property market used to be a median price of $200,000 in Port Hedland and went all the way up to nearly $1 million, and then in a space of a year or two, and then it dropped back down to $200,000, and that was because the mining sector dropped off. So when we're looking at a region, we want to make sure that the minimum 5 economic drivers that are greater than the state or territory average. So what I mean by this, if you're looking in a town in, say, Victoria, and you're looking in this town, it's got 5 of these economic drivers that are greater than the state average of Victoria, that means that's a positive thing, because these things are driving that economy. As well, you look at previous history data and you see if that's been trending upwards. If it is, that means that's a positive thing. These sectors are growing in value. And so what that does, it creates a higher GDP for the economy of that particular suburb. So this is really important, because this is what creates jobs and gives and grows that region. Number 3 is government policies. Okay, governments will come out and they'll create policies that stimulate the economy. For instance, COVID hit, first home buyers grants always been around, but there was different grants available: renovation grants, investor grants, NDIS housing grants, tax law concession grants. It was all different types of grants and policies implemented. This created a frenzy buying as well, gave opportunities to people to get into the market and gave them, concession and discounts. So it helped them get into the market. So it's something to look out for. And this is something you have to read articles and read policy agreements. And this is something that we look at because this will have an effect on the property market. News articles are very, very powerful. Something like Financial Review and stuff like that will give you this insight. Government policy is something to look out for. Now, next thing is number 4. We've got state and federal stimulus measures. So from a federal level, they'll create a plan. Then the states will create a plan. And these plans are create jobs and create educational systems or, educational grants. And so this will help stimulate the economy. It gets the economy rolling. It helps it lower unemployment, create productivity. Something to look out for. If we look at from a federal level, that's amazing, but we need to know from a state level, and then we go from a state level. We need to know where's that going in that state, what regions, what pockets. Gives you a great informed decision. So you can start looking at what's going on. What's the targets? Are they trying to increase employment, and of course, are they trying to increase the population? What's the plan? This is something to look out for because this is something that's really, really powerful. Okay, now we've got APRA. APRA credit policy. So APRA control the credit policy, so they can control who gets access to credit. Now they can change the laws, of course, and they can they create risk management. They give you access, credit to investors or owner occupiers, and they can change that criteria. And of course, the way they assess credit. Now, at the moment, APRA has actually tightened up their credit laws. So what they have, it's a little bit harder to get credit, but only by a fraction. So why they've done that is because they don't want people to get too much access to credit, that people that really can't afford to get that credit, where they put themselves in a risky position. But Australia is very, very due diligence with this, especially APRA. In America, back in 2008, when the GFC hit, the global financial crisis, what happened was in America, they don't have APRA, but in America, they were just giving away loans. They called them ninja loans. And this is what happened. A lot of people were getting access to credit and just buying things with it, buying property, buying cars, buying whatever. And what happened is they couldn't afford to pay those loans back. There was a lot of property, and a lot of assets, a lot of goods that these people could not afford. And what happened was there was a collapse in the economy because people couldn't pay back this loan. So what happened was the economy crashed, the property market crashed. But in Australia, the property market did not crash. Why? Because APRA has a great credit policy that is, it's really due diligence, and it puts a lot of risk management involved. And so this is a positive thing. But it has had a slowdown in the markets. Back when the Royal Commission hit, they made it very hard for investors to get access to credit. They were tightening up interest-only loans, and it was very difficult to get interest-only loans. And if so, the rate was very high. And so things like this can stop buyers' activity as well. So it's something to look out for. Looking at APRA policies, looking at their website, they've got a very, very informed, detailed newsletter. Next thing, movement of people. It's all good if population growth is happening in a region, but we want to know what sort of people they're coming in. Is it internal migration or overseas migration? Now, we don't want to look at overseas migration because people that are coming from different countries moving into particular areas, 9 times out of 10, they can't afford to buy a house at that particular time. So they're renting. But we're looking at people that are internally moving around in the country. Now, if we look Melbourne and Sydney, there's a lot of people that moved, and a lot of them went to Queensland or the regional towns in these states. This had an effect on those markets, a massive effect. Why? Because internal migration, people have money. They've been established here for a very long time, and they're going to influence those markets. If you've got over 35,000 people leaving Melbourne and they're going to regional towns or into Queensland, this will influence the market. Okay? If you get 100,000 if you get 1,000 or 1,000 people going to a regional town, that's going to influence the market. It might not seem a lot, but it is, because a lot of these, there's a lot of stimulus happening to a market. So when you look at internal migration, this is something you can look at ABS data. Low listing levels. Now, people think, COVID had an effect on the property market, which it did, but this was a tipping the tip of the iceberg, the COVID. If we look at from 2016 to today in 2022, now this data goes to 2021, but listing levels were getting less and less as the year went on. Now, doing so, that means there's less listings getting presented to the market. What happens? Then there starts to be more buyers, and so, demand starts to outstrip supply, and that's where this comes in, and this is where, then there's less property in the market, but there's more buyers. Create supply versus demand. Something that we look out for, and this is where we look at it from not just a whole of a state, but as well from an actual region or a suburb level, and this gives you a great informed decision. Next thing is low vacancy rates. Vacancy rates is the rental vacancy. So the lower the number, the less properties on the market for rent. And then when there's less properties on the market for rent, what happens? It creates more demand. So at the beginning of a surge in the market, you'll start to see low vacancy rates starting to get lower and lower as the months and years go by. Doing so, that then I guess you'll start to see listing levels of sale listings will start to be lower and lower as it goes by. So they're both trending down, vacancy rates and total listings. So they correspond with each other. When this starts to happen, you are going to see growth in the market from a sales perspective. So something to look out for, and this is what you need to understand as well. So there's a lot of things to the puzzle. Okay, the exodus to affordable lifestyle. So a lot of people might leave the capital cities or go to the capital cities, or might leave, the suburbs and go to regional towns or to the mountains. This is something to look out for, because this is something that COVID started a trend, and you can work from home and you can leave the suburbs, and then people are selling their houses in the suburbs, in the CBDs. They're selling them for a fair quid, and they're going out to regional towns or the coastal towns where properties are a lot more cheaper. They can buy a beautiful home that they've dreamt of, where they can live and work from. And that starts a surge. Not just that, of course, people that are retiring, or maybe people are just moving to a different location because of work requirements and because of job opportunities as well. Okay, so it's not just about COVID; it's about job opportunities as well. So it's something to look out for, when you're in a particular market. Access to low cost credit, interest rates. So if interest rates are low, of course, there's going to be access to credit, and so interest rates do have an effect on the property market, but it's one part of this. And this is something to keep an eye out for, because if there is low interest rate, you're going to get access to credit. And if interest rates do rise, it's not a bad thing. Actually, property prices do rise if interest rates do rise, and actually rental income does rise as well. So the rents will, follow that trend as well. So there is a video I've created to show you that, if interest rates do rise, the property market does not crash, which it doesn't, because it has happened before. So people just need to understand if there's a lot of other fundamentals involved, like I say, jobs, creation, movement of people, desirability, etc. People aren't going to worry about interest rates. If interest rates go up, 0.5% or 1%, because they're going there for a purpose. So that's where you got to understand. People are moving somewhere for a purpose, but this does have an effect, interest rates. So when we've got investors versus owner-occ, this has an effect on the market. Now, there was a period, as you can see, when the Royal Commission hit around 2015-16, the market dropped of investors, buyers activity. The market dropped for investors. Why? Because they made it very hard for investors to get access to credit. This comes back to APRA. So what happened was it got released, and then you started to see a surge of owner-occs, starting to dominate the market, because it was now to dominate that market. Now, what's starting to happen is there's starting to be a trend where they're both starting to be a buying frenzy. So this is creating, a competitive war against owner-occupiers versus investors. Something to keep in mind. Now, recent uplift in buying from foreign investors. People think that COVID hit, there was foreign investors weren't buying property in Australia. There was a lot of foreign investors buying property in Australia. If you can see, there was over more than $6 billion worth of property being purchased during 2021. Okay, it's a little article here, something to look out for. So this had an effect on the Australian property market, and this was pushing up prices as well. So something that we look at as well. So a lot of news articles, a lot of government reports, state government reports, and I guess council reports give you these insights. This is something to look out for. Where are these people buying? That's a great question. Inflation of money supply. So during COVID, Australia printed $500 billion. Okay, So when the money was created, money loses its value because it's not scarcity anymore. It's losing its value because there's more money in the system. So you need more money to pay for goods. And then that creates lower interest rates and increases property prices, increases goods and services prices as well, because you need more money to pay for goods and services and assets. So when this starts to happen, okay, it can be a positive and a negative thing for the economy. Okay, inflation, when money gets printed, normally inflation starts to creep up and things start to increase, which we've seen today. So this is something to look out for, and this is something that you look at the RBA and what they're doing with their policies. Are they increasing the money supply? Are they taking money back into out of the system? This is something to look out for. Really important. I love this topic, and this is something that needs to be spoken about in an individual manner, because it's something that people do not know much about. It's really important to understand this. So if you start to see money getting printed, there's a hypothetically chance that the money supply is going to lose its value and prices are going to rise. So let's lead us to the next one. Cost and goods and services rise, and that's because of inflation, the money supply. But as you can see, since the dollar, so the American dollar, which is a little history here for you, the American dollar used to be backed to gold back in 1971. So you couldn't print as much money compared to what they do today. It was different. It was back to gold. So they need to hold gold in their vaults, and they could release a certain amount of credit, which was cash. Now that no longer exists. Okay, President Nixon destroyed that, and he created a thing called fiat currency, which it is today. And now all over the world, every country can print as many dollars as they want. So by doing so, since 1971. What has that created? It's created inflation, especially intense inflation. As you can see, from 2019 onwards, you're seeing inflation rise, and you're seeing that the cost of products and prices increase dramatically. So by this happening, prices of petrol, prices of goods and services, food, and everything else will rise. So will property. So this is something to look out for. Looking at trading economics, there's a little website here that can show you this and give you information on what's going on. Last but not least is building approvals. So we need to know, is there a large number of building approvals getting released? Now, from a sector of a state level or a city level, it gives you okay, you can see what's going on. There's a lot of building approvals getting built. The more building approvals can be a dangerous thing in a suburb. Or an LGA level, I should say. LGA is a council level, so it's a council and there might be 10 or 20 suburbs, whatever it may be. If we're looking at an LGA level, we want to see how many building approvals they're being released. And if there is a lot of building approvals getting released to the market, what's going to happen is it's going to outstrip your demand, because there's going to be more supply getting implemented into the into the LGA. And so when there's more stock coming to the market, what happens is there's going to be less demand, and so prices can drop. So we want to make sure there's not a large number of building approvals. We have to be really understanding of building approvals, because what are building approvals? We want to make sure it's houses. We don't, if you're investing in houses, you want to look at houses building approvals. You don't want to look at apartments or townhouses or, commercial properties. You want to look at houses and seeing how many houses are getting approved to get built in a location. Now, we invest in areas that are established, they're not new estates, but you might see a location that's a new estate and then building approvals are going through the roof, and there might be so many building approvals getting released. This means that there is a large number of properties getting built that can outstrip your demand. So something to look out for. So they're the 15 key influences. Hope you got a lot of clarity from that. It's a long video, but this is, if you watch it to the end, very thankful for you taking the time to watch this. This is really important. A lot of people don't look at these things. There's 0.4% of Australian investors don't own more than 3 investment properties. 0.4. Don't own more than 3 investment properties. The reason why a lot of them aren't using this formula. And this is going to help you make an informed decision. So use this wisely. Understand what influences the market. You will learn a lot. It educates your financial IQ when it comes to property, and this gives you a lot of clarity moving forward.